had started, one of our earliest investments was in Sleepy Owl, and they continue to stay to be our favorites. And I've got Ajai Thandi, the founder, one of the co-founders of Sleepy Owl. Hello.
Hi, Archana.
So, you've seen, through the course of Sleepy Owl's journey, you've seen the way the market has been, the private market has been in the investment sort of space. I think I'm going to do this whole thing that now you be the Gyani Baba and tell me what are your learnings from this 8-year journey of Sleepy Owl, where there's been fraud from private investors, there's been the funding winter, now things are looking maybe happy again.
I think the biggest takeaway is that fundamentals never go out of fashion. And when you start early, you think the investors or your guides or mentors who are telling you stick to the fundamentals, you dismiss them being old school, that this is a new way of doing business. So in going through these ups and downs and different cycles, that is number one learning, stick to fundamentals. And second is building in or developing this sense of patience, because in any business things take time. Consumer business definitely a lot more, and consumer businesses in India way more, right? So having a sense of patience while you're building brick by brick, I think is a very important underestimated skill that founders should have.
So you're saying the fundamental is to be patient, the fundamental virtue.
Fundamental virtue is that traditional, like profit-oriented way of building, not chasing revenue, not chasing growth at any cost. Being very sharp on unit economics. Something you always talked about, and even in our conversations that we've had, is that customer is king. Listening to the customer.
Basically, investor is the queen. Investor is queen. How about that?
Investor is the enabler of the whole ecosystem, very important part. But essentially, if you're not listening to actually an investor who is a consumer is even better. But listening to what the customer.
Cheers to that.
Cheers.
To some Sleepy Owl.
Cheers. Thank you.
Okay.
So, I think that, and then obviously, when you're young, you want things really fast, because all the stories that you see in the world are glorify fast success, overnight success. But one needs to take a step back to understand years and years of hard work goes into making those overnight stars. And patience is truly a virtue that either you learn through experience, or you learn through, actually you only learn it through experience. Yeah.
So, when the three of you started, you guys were in your early 20s.
Yeah, mid-20s.
Mid-20s. Mid-20s, early 20s from where I stand. I remember you guys, did prioritize things like, some of those interesting titles which were trendy back then, Forbes 30 under 30.
Yeah.
Older and wiser.
Yeah.
Do you think that has any impact? I mean, if there's a founder starting out today, what would you say to those founders? That do you optimize for that kind of sort of tag, or stay away from it?
See, not only those, the lists like Forbes and GQ and all that featured us, but there's also when you raise funding, right? A lot of people in the early days want to raise funding for validation, gives the world. Your name gets, and your company's name gets printed in Economic Times and all the leading business publications. Those do seem as milestones, but they're wrong milestones. They're very ephemeral in nature. What truly matters is the fundamentals of business. Sooner you realize that those things are just a distraction, what matters is to, again, going back to fundamentals of how you're building a business and how strong it is. That matters more. And I can advise as much as I would like to say to the young guys coming on board, but no one will listen.
You become an investor now. That's what we think. Nobody's going to listen to us.
Yeah, you have to go through your own journey. But yes, if you were to ask me that you're getting that validation from XYZ paper, is that going to really change the game for you? I will say no. While it will come with certain appreciation from your close friends and family, yeah, you can enjoy it, but You should be very, very aware in your mind that these are ephemeral in nature. They're not true reflection of what you're building.
But you're a consumer brand, and in fact, one thing that Sleepyall is really known for is the brand you guys have built.
Yeah.
So, in that context, isn't this kind of validation important, or
I
do you think brand is built in some?
I think that validation did not lead to the brand. Brand was built by, again, going back to very sharp consumer focus, right? When you think of Sleepyall, you think of coffee, right? We didn't really diversify beyond that core product that we were offering to that core consumer. When you think about brand, the other feature is who are you targeting? We are a brand for Gen Z and millennials. We offer products that are superior in quality, a premium product to a consumer. We stuck to those things, and that continuous and consistent promise that we make to the consumer when you have a Sleepyall product, it will be convenient to use, super tasty, and packaging is playful, and when you drink it, it will give you a sort of cool feeling. Those things have stuck by, and that is what's built the brand.
Right.
And we are very, very clear that as founders, we have to dissociate ourselves from the brand. The brand has to always stand on its own and be bigger than who we are as individuals. And that goes back to, again, as a company, and we've had that discussion, we've never really gone down the route of the shortcuts of brand building, getting a brand ambassador on board.
We are on the same page on this one.
Which doesn't work.
It just doesn't. My God, I don't understand why so much money has been wasted on this.
Well, again, you try to do shortcuts to get top of the mind recall from consumers. It can work, but I would say majority of
consumers are too smart. Yeah.
Majority time it doesn't. So when it came to us building a brand ambassador, we built the owl into a brand ambassador for ourselves.
How's the owl doing though?
Owl is good, has a lot of fun, has his own personality. Next time.
Yeah, we should get the owl next time. Yeah.
That would be funny.
Yeah.
The owl sit in the back.
Yeah. We need some color. We need equal representation of the entire animal kingdom.
Correct.
So we must have it next time. So you went through the whole COVID years, like I said. You saw the fraud during those years, the investment money. And now, of course, you've seen the funding winter. Of the lessons learned, how do you feel about fundraising? Do you think you should have raised money? Do you think if you were to redo it, would you do it differently? Again, younger founders, they're listening to you.
Yeah, I think, fundraising is important. Definitely, it does give you a war chest to go and build products that you're trying to take to the world. But if you're using it for buying sales and shortcuts, it will hurt you.
But if you're doing that in the market?
Sports all the time.
Really?
Yeah.
Wow.
But ideally, if you're building it for growth, you're building it for not for product market fit, but once you have product market fit to reach more and more consumers, it's absolutely essential. And then another aspect of fundraising, which I think is very critical in early stage companies, it brings a sense of, it takes your experiment, which most startups or early stage businesses are, and builds it into a real business, right? And it comes with the sense of responsibility, fiduciary duty to the investors, corporate governance, compliance. All those things are very, very critical in a business's journey, and I think that level of maturity comes into a company once smart money comes in.
And is all VC money smart money, or?
I would say definitely institutional VC money is smart money. I would like to believe so, right? Because they have systems and protocols in place they have a lot of responsibility when they're raising from their LPs. So similarly, when they're deploying, it comes with some sense of insight and viewpoint when they deploy.
With great power comes great responsibility.
Of course, definitely.
So, I always like to hear the portfolio founders ask me questions. So, go for it. Do you have anything that you can ask me back questions also?
So, Archana, how's last 2 years been for you going through the funding winter? What has changed pre-funding winter and post-funding winter for a fund like Rukam from your investment thesis perspective?
For us, nothing changed. From our investment thesis, our thesis has been The only thing I would say is changed today is suddenly we are looking fashionable. We looked a bit old-fashioned in our whole, emphasis on don't raise money for the sake of raising money, be capital, be very, very conservative with how you deploy capital. And I think the reason our portfolio is in a reasonably decent situation is because we back those founders, who probably had that DNA. And I think, we believe that mistakes will happen. And I think mistakes happen at every step of the business building. I don't think there's any business that is ever devoid of mistakes. And of course, as the business becomes bigger, those mistakes can be quite expensive because, proportionately. But I think as long as our portfolio founders are cognizant about the fact that mistakes will happen, own it up, find a way to mitigate it, and of course also learn from it, because we hope that our founders make new mistakes every time. We don't want the old mistakes to be made.
See, business by nature is risk taking. If you're not comfortable with taking risk, then you should not be a founder or an investor. And when you take risks, it can go either or way. Idea is to make sure that the downside is capped to some extent.
Exactly. And also, the intent when you're taking a decision which goes wrong, to my mind, has to start with very solid reasons. So, my problem with a founder would be if it's very casual or there's a malified intent. I think if a founder is very casual about decision making, deployment of capital, I have a serious problem with that. But if a founder is taking a large bet based on having done the work, trying to understand, and that goes awry, I mean, it is likely to go awry. I mean, there's a 50-50% chance, right? The probability is, in a sense, always stacked against an early stage company. So, and we are in for that, right, really. So, I don't have a problem with mistakes. The intention behind that is more important.